Welcome and thank you all for joining us for this episode of the Matthews Podcast, a podcast highlighting commercial real estate news, topics, and trends from top professionals in the industry. I'm your host, Matt Wallace, market leader and national director of shopping centers here at Matthews. Today, we're launching our publication takeover with our National Shopping Center Overview, where we break down the trends with the help of our regional experts. Today, joining me to discuss the West Coast is Matthews Senior Vice President, Matt LoPiccolo. Matt LoPiccolo is a leading retail investment sales specialist at Matthews Real Estate Investment Services. Based in San Diego, Matt has spent nearly 4 years with Matthews and has been instrumental in closing over $1 billion in transaction volume across the West Coast. His focus is on regional and neighborhood shopping centers, where he combines deep local market knowledge with Matthews' national platform to help clients navigate an ever-changing retail landscape. What truly sets Matt apart is his commitment to building long-term relationships and guiding investors through both the challenges and opportunities that define today's retail market. Matt, thanks for joining the podcast. Welcome to the show.
Yeah, thanks for having me, Matt. Happy to be here.
Well, before we jump in, I'd love to hear just a little bit about your story. I know your background, obviously, but I'd love to share your story a bit with our listeners. You know, you built a really strong presence in the retail investment sales markets. What originally drew you to retail and this side of the industry?
You know, honestly, when I first moved out to San Diego out of college, I did not have a keen, or let's call it a specific asset type to focus on. I just wanted to get into the business and start my career. So I worked at a local boutique that was solely focused in San Diego County. So over the years, kind of grew my business and moved on to various firms, all through, having that emphasis then on shopping centers. It wasn't until I got to markets where I realized, my transactions typically were shopping centers. And so I became a little bit more specialized in that regard. And then from there, you just scale with your clients and market knowledge. A lot of it was just predicated on what we call street level information, whether that's lease up, ownership info, like we even went into the details on the CAM. So I think that with a healthy amount of persistence kind of led the way locally. And then we're able to have some success in expanding out of the market. So all in all, it led our group to an opportunity to continue to expand that segment, but mostly in the shopping center in grocery anchored space.
Did you have an aha moment at some point early on where like, man, like specialization is the way to go? Like that's where the value is?
Yeah, that's a good point. I would say, I guess you want to say yes, but reality was I wasn't aware of it because I was continuing to do just shopping centers, right? Yes, you'd pick up some net lease deals here and there, but what really got me going was the understanding of the asset, how complex it was at times, but at the same token, what were the clients' like value metrics in terms of where they identified value? Because each deal had its own business plan. That's what was really intriguing, and how others approached the asset. There's always a story to tell. In some scenarios too, the deals that had a little bit more hair, the tough ones, I have a special place in my heart for those deals. The ones where your manager looks at you and is like, what the hell are you doing taking this out? And just having that belief, that determination that, I'm going to find a way to get it done. So you learn a lot about yourself through those assets, and hopefully that positivity, that commitment transfers over to both your client you're representing into the market, and that you're, obviously selling to.
Yeah, that no one ever accuses the shopping center guys of taking the easy route, right? Like I tell everyone, if you can sell a large format shopping center or a mall, which you've also done, probably the craziest of the assets, you can sell anything, and I think that's part of the fun of shopping centers.
There's a truth to that, and I've always had a knack, I guess, whether intentionally or not, of finding myself in some adverse scenarios. But you learn a lot about yourself, and opportunities come from that. And I honestly enjoy it. It's good to have sometimes that pressure or that back against the wall moment. Really gets you motivated and hopefully better.
Absolutely. We're going to focus this series, very regionally about what's going on in your market specifically. So why don't we dive in a little bit to, Southern California and West Coast retail. It's one of the most competitive, certainly one of the most expensive. What are you seeing broad strokes right now in terms of capital markets and financing and getting deals across the finish line?
Yeah, I would say capital markets is a very important pillar in terms of asset selection and getting the market comfortable. As you're seeing capital costs having gone up, both on the acquisition side, whether that's a new loan or what we're seeing now too, is the improvement cost. So the market is balancing that in terms of its going in risk to get a better feel for what the near term opportunity or downside is. So yes, yields or spreads on cost will be and continue to be a metric that the market takes into consideration. Obviously, I'm not saying anything earth shattering here, but that's just the first step. And then you got to look at near term turnover in the big box space. How much will that be per foot to lease out? Is the brain damage, the time, the cost worth for the investor? And that's where you see a little bit of the offset, right? Where an owner who's had an asset for, let's say, 10, even 20 plus years, for the most part, the disconnect on their level, which is somewhat understandable, it's hard to understand the horizon in a sense of risk when you've had a performance history so strong where even if you have some near-term turnover, especially in the big box, I don't want to say it's hard for them to understand that cost, that downside. It's just not in their vernacular as they haven't had to deal with it in a low interest rate market for so long, where therein lies the risk level to the buyer. So, and then trying to track yesterday's yields, that's where the fun begins in terms of the back and forth. So you're seeing a marketplace on the demand side still very robust. I think inventory levels have been still relatively low. Assets that are more value or core plus are going to have a different profile of buyers primarily. But again, one of the most sought after asset types in California has been that value add. Now, the value add definition has transformed a bit over the last 12 or 24 months because very rarely are you seeing any near-term value-oriented deals that have a clear path forward. There's a lot of cost. There's a lot of cleanup that has to be done on the investor side, and understandable. They're going to want to be rewarded for that risk or potential uncertainty.
Yeah, you jumped on my next question. It's like, where do you find that value add? Because when you're looking at, the West Coast and certainly the Southern California market, I mean, like you said, we've got very strong fundamentals. We've got low inventory. So what deals are trading and what's the profile of what's actually moving on the market today?
Well, it's I would say predominantly, whether it's value add or stabilize, it's understanding what your downside risk is. Then from there, it's a function too of what your spread or cost of capital is that mimics what you're simply underwriting to. So deals that are penciling still have that, like the cap rate has moved up a bit just given where cost of capital is. So that's going to be an important feature. Then another element that's popped up too is your operating expenses. We've seen, I think, just, generally speaking, about a 35 to 40% increase. And this is where it can be the Achilles heel of a value oriented deal. If you have an owner that's been in the asset for 10, 15 years with a relatively low basis, how then does the market interpret the reassessment on taxes? Even if the leases are triple net, can you underwrite 95, 100% absorption? Well, it's very dependent on obviously the asset, the age receivables from the tenants in place. There's some on-site, investigation that is required from investors when they're speaking to those tenants potentially. So there's more work to verify where the upside or the downside could be. But, that just goes to the complexity of the asset and how you're navigating through it. And then obviously too, It's going to be the requirement of the investor. Can they be patient for 5 years, 7 years, 10 years? That will have an impact on how they approach the deal.
How have rents been reacting over the last, call it, decade, and even since COVID? Are rents running up enough to cover some of this increase in OpEx, or are the landlords getting squeezed as the triple nets are taking over the larger share of any increase that's getting through?
Well, the good thing about retail in the last 10 years is with structured rents, you haven't seen inflationary rents like you have in other asset types. So that's been the plus. Where the rub is, when rents reset to market, the tenant's paying one check, right? They have base rent plus cans. In their mind, it's $4 all in. Are they able, on the renewal front or the new lease front, able to achieve market rent, resetting their tax basis or CAM cost up? That is a big, consideration. So for the most part, though, we've been well insulated on the inflationary front. And ultimately, too, on some of these new leases, I've been surprised at some of the rental values that we're seeing from other big box or even end cap type tenants coming to the market. Some grocers, are getting well over $20 a foot in rent, and they're comfortable with it so far, I should say. And again, that there's some movement in how that number can be. Is that really the rent, or is that a function too of cost being amortized over the duration of the lease? So again, that's another element that investors are taking into consideration on whether they approach a deal or not.
Let's dive in a little bit on some of the tenants, the ones that are paying the rent, and consumer trends. And you guys, I mean, I'm sitting in Ohio. We get all the cool tenants, about 6 months after you guys get them out on the West Coast. So where am I going to be eating in 6 months? Look into the future a little bit. Who are the hot tenants out there?
Who are the hot tenants? Well, it was gyms as of a couple of years ago. You're seeing an emergence on the obviously the coffee front. That has been a very popular tenant out here, in my opinion, a little oversaturated. But you're kind of seeing like a mix of that fast casual tenant that is in the restaurant category. They seem to have the most bang for your buck, or the more, consumer oriented atmosphere, right? Like years ago, we had the emergence of grocers that provided that experience where the consumer can go in, not just shop, but also pick up lunch, pick up a hot plate for dinner, whether there's cooking classes. It just brought a different, call it interaction with the consumer than just your standard, picking up groceries and leaving. So I think with the fast casual, there's, the dining category of restaurants, that's always been call it like a junior draw to a shopping center as well. So what will that tenant be from California to Ohio? I don't know if it's going to be in the healthy category, Matt. That's the only downside for you. So
I didn't say it had to be healthy. So.
Yeah, it's a good question. I'm going to have to get back to you on that one. I can't think of, tenants that have a presence in California looking to go into the Midwest market. It's not a knock. It's just, a whole different operating climate out here than it is in other parts of the country too.
Certainly is.
Yeah.
So we've had some other big trends that have impacted real estate, particularly the work from home to return to office. Have you seen the retail landscape being impacted by those broad macro shifts, and are developers taking that into account when they're designing either new shopping centers or new strips?
Yeah, I'm sorry. The first part of your question got broken up. My computer just timed out on me.
Yeah, so I said we've seen some large macro trends over the last couple of years, certainly post-COVID, in terms of work from home and now return to office. How has that impacted retail, and are developers taking these macro trends into account when they're designing new retail centers?
Yeah, I think they are. One of the trends that, I've been paying most attention to is what I call post-COVID rent, especially on the build-to-suit space. it wasn't too long ago where a single tenant coffee use in San Diego, we sold a deal at almost 155,000 in NOI. And I thought, man, that's setting a high watermark. Now that same use, that same build-to-suit structure is almost 60% higher in annual rent. And
Wow.
so what you're seeing are tenants understanding that the developer's cost and risk are a factor in their expansion plans. So it makes sense for the tenant to participate in paying higher rent. However, the market is seeing the risk there. Even if there's a 10-year or 15 or 20-year deal, the investor sees concern that these are very high rents that can impact profitability. And the lease typically does not require the tenant to produce sales or even P&L statements. So the post-COVID rent is going to be something to pay attention to in the next, I would say now and for the next 5 years. How will that impact the marketplace? And that's why I believe you're starting to see yields or caps rise a bit, because you have to offset that risk. So to simply answer your question, it has impacted developers, whether that's build-to-suits or even repositioning big boxes as well, because that cost, that downtime has been somewhat baked into the rent structure. And will that be profitable or viable for that tenant through the duration of the lease?
It's funny when you mentioned the post-COVID rents, and I first got into retail like right after the GFC, and over the last 15 years, I certainly see like I can read a lease or I can see a rent on a rent roll and be like, oh, that rent was cut in 2005, or that deal is from 2014, because there's these moments in time where these tenants would either, exercise their leverage, or they'd have to take it on the chin and turn to try to get these things signed. So it's always a little party trick if you're a retail nerd, I guess, to decide, when and what the lease rent were cut. So moving on to, I'd say your investors, so your clients, right? What are the biggest questions that they have for you, and what are those big kind of trigger points that they are looking for in shopping centers or strip retail in general, that you're able to really kind of really add that value and help them to make the best business decision for themselves?
Yeah, absolutely. It's the term basis. Every profile of shopping center to your 10,000 square foot all the way up to your grocery anchored is basis, right? Even if you're going in at a very attractive basis, with the work that needs to be done to create the value, does that expose the client or not? Where's the risk? So when you start from a basis standpoint, that really helps the conversation depending upon what the asset profile is in terms of how you're communicating to that potential buyer. So that's a very important thing too, is not just the basis, but identifying correctly what that asset is. The value add term gets thrown around so often, or same thing with the stabilized term. Well, is it stabilized to the debt that the client's taken out? Or is this a 10-year stabilized deal just on a general basis? So you really have to fine tune and understand what the client's definition of the deal is, and making sure that's aligned with what you believe it is, right? It's just very simple, right? Just like how we propose assets. What's one of the first things we are tasked with when sitting in front of a client is, this is the NOI we underwrote to. Do you agree with this? All right. Same thing on the solicitation side of it. This is what we believe that this is a value add deal. Do you believe that? Yes, I do. Great. How do you get there? That's the genesis of those conversations that we're having in this marketplace. And as you can imagine, there's so many layers into that of what they define as healthy, what they define as a risk or something we need to get back to. And a lot of it too isn't even so much the rent roll or the operating expenses. There could be an environmental issue. There could be some regulatory concerns, you name it, that is going to then offset the appetite or interest level in the deal.
Yeah, certainly uncovering those landmines is worth its weight in gold for any broker working with a client. And you can only really figure out how to avoid stepping on those with years of experience and having seen other people make those mistakes.
Oh, you're still going to step on a couple. You just got to make sure you get back up.
Yeah, make sure they're not fatal, right? Yeah,
it's going to happen.
So we've seen a couple of blockbuster deals out there, right? ROIC just went to Blackstone not too long ago. Where are you seeing some of the opportunities, both from the institutional side, but then also maybe on the smaller private equity, high net worth side? Where should investors be focused?
Yeah, I mean, look, it's just fundamentals. In a sense of funds have a different, let's just say, metric than the individual or the high net worth private client, right? They have to achieve a certain yield. They have to put their investors' dollars to use and make sure it is, in line to what their business plan or expectations are. So that space is going to be, a little bit of an outlier in a sense of where market value is. I mean, as you can see, right, with Malone Guyer relinquishing, I think 18 of their assets on the West Coast, it's a fund to a fund type transaction where, that buyer coming in there, has a great, portfolio now on the West Coast where they identified a need to, have assets. Now, the private client, right, is going to be a little bit more sensitive, I believe, to the fundamentals itself, whether that is near-term rollover, whether that's going to be the management side of the ledger. Debt too, their cost of capital is going to be higher than obviously a fund's. So that plays into the picture as well as to where are these assets going to market at. And that's still, not saying anything surprising here, that is still the biggest challenge we're seeing in the marketplace is expectations on the ask and obviously where the market feels comfortable in transacting.
So, Matt, you've been navigating this hyper competitive West Coast retail environment for how many years now? 15 years?
Yeah, I would say.
What was a lesson that when you started would have really helped you? Like, what is some advice for some of the young brokers or even young people starting their careers at acquisition shops or REITs or private equity funds? What lessons could you have given yourself back when you were just starting your brokerage journey?
I love that question. And it's simple, in my opinion. Do not be afraid to fail. You're going to not, you're not going to win every pitch, right? The opportunity of sitting in front of a client is the win. The deals will come, right? It's relationship building. You have to give respect to groups that have in place relationships with other brokerage or brokers. It just takes time to maneuver through that, and to me, that's what you could walk away from a pitch saying, hey, we put our best foot forward, right? We identified the upside, the downside, and spoke exactly to how we're going to market this deal. Some clients will say, look, we just owe so-and-so a deal. You have a low opportunity to get it. Fair enough. We're going to take that shot. So that's what I mean by do not worry about failure early on. You focus on getting yourself in the arena, get yourself in that boardroom or on the phone with that client. That's where success happens. And it's a consistency of doing that over and over again before all of a sudden, as you know, in our business, it's a compound effect, right? You fail, you fail, you fail, and then all of a sudden, boom, there's your opportunity. And early on in my career, I would say my first two transactions that kind of put me on the map were the result of being the third or fourth guy in.
Just being the one that could figure it out.
Yeah, you got to play a little rough in the paint in terms of being, persistent and aggressive. And when you get your opportunity, make the most of it. And sometimes it's not just the outcome that the client is valuing you on. It's the service. From the moment of engagement to completion, how are you speaking? How are you communicating? What value to them are you delivering? Because deals are fluid, decision making is fluid as well. So as brokers, we don't know exactly what the probability of execution will be. We simply don't. But to give the client the best information is critical for their decision making, because sometimes clients will pivot and say, you know what, it's maybe not the best time for us to achieve an exit. Maybe we put short-term debt on this for various reasons. So you have to continue to explore that too with the client, because in shopping centers, right, you underwrite it in April, well, come July or August, maybe a tenant that you thought was safe and healthy is no longer the case. So that can change the perception of the deal.
I love that discussion on failure. We have a large quote in our office that says, failure is not an option, it's a requirement, and it's one of those things that you have to get over very early on in your career. Certainly. I agree with that sentiment.
Well, you guys are near Columbus, right?
What's that?
That was a jab from a Michigan guy to Columbus.
I'm a Penn State guy, so it's gonna. So you're just kicking me while I'm down. So,
Hey, I didn't mean it.
But we're
nothing personal.
So obviously, you and I have been in retail for quite a while, and we've seen the overarching headlines and the overreactions of the Amazon is taking over every aspect of retail, and retail is dead, and bricks and mortar are dead. How have you been able to navigate some of those, maybe the headlines and even the cycles that we've seen, and keep your eye on the ball and just keep getting deals done?
Well, I'll tell you this, I learned, I think through every cycle, there's always a headline or two. Don't believe it. It's talking points. That's all it is. None of it has come true. Right? It took Amazon to get bricks and mortar so they can do what? Have both a point of need from a consumer as well as fulfillment center. It's very difficult, I believe, for, especially in the grocery category, to rely on third parties. There's not much of a margin in that ticket. So now if you have, let's assume 10% profitability on a $100 ticket, that's $10. How are you going to carve that up to third parties? Now, is the consumer going to lose a little bit of its quote unquote touch point with that grocer because maybe the perishables aren't that good or up to their standards? So the profitability on the online fulfillment to the customer was something that we paid attention to 2 to 3 years ago. But, the retail is dead category to me was just a great way to create some kind of fear or concern. It didn't make any sense, because at the end of the day, look fundamentally from a retail standpoint, it's some of the best positioned assets for consumers, whether it's on the way or it's, strategic. It does offer value. So if a shopping center from a retail standpoint is going to change, well, that location will serve as a foundation to make sure it's adapting to what those trends are. So yeah, I mean, those headlines are just that, very good ways to create a stir and, have something to speak about, but nothing happens that quickly. And especially too, when you think about it on a municipal level, you think municipalities want to lose their sales tax?
Nope.
Probably not. So it was just always interesting to me that was something, that caused a stir. Because I remember my mom even called me. She's like, "Oh my gosh, what are you going to do?" I said, like at the end of the day, it's dirt value and it's fundamental. So if it's not that use, some other use will come in, and the users themselves will learn how to adapt to the changing needs of the consumer, like an Amazon who acquired Whole Foods, to make it a little bit more strategic from both a shopping experience as well as a fulfillment use.
And so we've talked a little bit about, your illustrious career here. And now, what has been your key to success really in maintaining those relationships? I mean, brokerage is a relationship business. How do you serve your client and really build those long-term relationships that have served you and your clients so well?
You just have to be yourself and authentic. right? You have to be trustworthy. You have to be aligned with them. But I believe just like you had any kind of relationship in your life, that authenticity that other person provides is what is most important. And from there, you're able to then have a healthy dialogue because, what I'm starting to learn more is how you present information in a fluid or ever changing market. And that is something that could give you an answer as a broker that maybe you don't want to hear, which is, this isn't the time to sell. But it's the truth, though. And
Mm-hmm.
that goes, I think, a long way. That speaks to your character. So it's just, call it like basic human value props that you provide to one another. And of course, too, you got to do your job. It's information gathering. It's providing them with some insights that they may not be thinking of or aware of. So, in a lot of ways, you're kind of like a news feed to them on what you're working on, or maybe you're running by scenarios with them as well on a deal that you may not think is a fit for them, but ends up being a fit. So, again, it's that news feed that being authentic, and I think that goes a lot. I think that goes a long way.
Absolutely. Absolutely. Be yourself, be authentic, build trust, and look out for the client's goals, right? And
Absolutely.
to summarize what you just told me. So I was writing my notes, scribbling down, but that seems like a very good way to build a solid brokerage career.
Yeah, absolutely.
Well, Matt, that's all we have for today. Thank you for joining us. That is it for our first episode of our publication takeover series. Matt, thank you for sharing your perspective on the forces shaping shopping center investment across your region. And to our audience, thank you for tuning in. To read the full regional shopping center report and other insightful features, check out Data, Deals, and Disruption, out exclusively on Matthews.com. Thank you.
Matt, thank you. Appreciate the time and having me on.
Yeah, absolutely. Thanks again.